Could Warren Buffett's recent caution be a silent signal to investors? In 2024, his strategic moves reflect a careful approach, hinting at concerns over high market valuations and economic volatility. Buffett's choices may reveal more than words, offering a glimpse into his outlook on today's uncertain financial landscape. Warren Buffett has long been known as one of the world's most disciplined investors, and his legendary approach to value investing has transformed Berkshire Hathaway into a financial powerhouse. His portfolio is marked by a deliberate focus on stability, high returns, and a sharp eye for companies with sustainable advantages, often called moats. Unlike many investors, Buffett's moves are never about short-term gain or speculative bets. He sticks to acquiring strong companies that show long-term potential, especially those priced below what he believes they're worth. As of June 30th, 2024, his top 10 holdings make up a whopping 90.46% of Berkshire's portfolio. This concentrated investment approach reflects his unwavering confidence in a few select firms that he trusts will stand the test of time. But recently, he stepped back a bit from the active buying and selling that marked his earlier years. But why though? Over the past year, Buffett's reluctance to make new investments or even expand Berkshire's existing holdings has sparked quite a bit of curiosity. What's driving this shift? Well, market prices are high, valuations are stretched, and Buffett seems to be holding back more than usual. Unlike his more aggressive strategies in past decades where he frequently added to Berkshire's portfolio, he's now taking a more cautious stance. The US stock market, after all, has been on an upward march for years, reaching new heights in 2022 and 2023. And guess what? The cyclically adjusted price to earnings, Shiller PE ratio, which gives a sense of how expensive or cheap stocks are based on long-term earnings, has hovered around 37, way above the historical average of 18 to 20. In simpler terms, stocks seem overvalued, making it harder for value-focused investors like Buffett to find good buys at fair prices. For him, it's never about chasing every opportunity, it's more like waiting for the perfect pitch. Buffett's strategy has hardly changed over the years. He buys when high-quality assets appear undervalued, then holds onto them for years, letting the magic of compounding returns build up wealth. This commitment to discipline has led to a rather unique situation. His portfolio now sees little turnover, even as the stock market bustles with activity. It's not that Buffett hasn't tried, even before this recent market boom. He was vocal about the challenges in finding attractive investment options. Back in 2019, he spoke about his frustration over the sky-high prices, wishing that he could make a large acquisition that would meaningfully impact Berkshire's portfolio. But those elephant-sized opportunities, as he calls them, have been hard to come by. There's also the matter of scale. Berkshire Hathaway is an enormous company, managing a portfolio worth hundreds of billions. This sheer size means that for any investment to make a dent, it has to be huge, multi-billion-dollar stakes that few companies can offer. Smaller or mid-sized companies might look like good deals, but their financial impact on Berkshire would be minimal. And here's another hurdle: regulatory thresholds. If Berkshire owns over 10% of a company, it faces additional compliance and disclosure rules. This means that for Buffett, even if he wants to increase his stakes in certain companies, regulatory concerns can discourage him from doing so. All these challenges have led Berkshire Hathaway to build up an astounding cash reserve. As of the last count, it stands at $182 billion, a staggering figure that reflects both Buffett's cautious approach and his strategy to hold back until the right opportunity comes along. Just for comparison, back in 2019, this cash pile was around $122 billion, which made up 37% of Berkshire's portfolio at the time. Today, cash reserves are closer to 50%. Some observers might see this as a lost opportunity, but Buffett insists it's all part of his plan. We only swing at pitches that we like. He's often said, making it clear that he's willing to sit on the sidelines, sometimes for years if necessary. Holding all of this cash, however, isn't without its downsides, especially during periods of high inflation. Cash loses value over time as inflation erodes purchasing power. Recognizing this, Buffett has increasingly invested in US Treasury bonds to keep Berkshire's cash working without taking on too much risk. Unlike cash, treasuries offer a modest interest return, making them a reasonable alternative. Historically, treasury yields have been low, particularly during years of near zero interest rates. But with recent rate hikes, short-term treasuries now yield around 4.5% for Berkshire. Treasuries offer a sensible way to preserve capital without fully committing to stocks. This shift to treasury bonds highlights how Buffett balances caution with returns. With limited appealing stock options, he's redirected a large portion of Berkshire's cash to short-term treasuries. These bonds act as a near-cash equivalent, with better returns than idle cash, providing a middle ground that preserves purchasing power while keeping Berkshire prepared to jump on the next big opportunity. Interestingly, Buffett's approach isn't about timing the market. He doesn't try to predict economic cycles or jump in and out of stocks, but he's hinted at bigger uncertainties that make keeping large cash reserves more appealing. Think about it. The world today faces complex issues from rising US national debt to geopolitical tensions with China, the ongoing conflict in Ukraine, and inflation in Western economies. All these elements create a climate of unpredictability. While Buffett doesn't let such factors dictate his investment decisions directly, he acknowledges that they make holding cash a safer option. With everything going on in the world, he feels comfortable keeping a hefty cash reserve instead of diving fully into stocks. This caution goes beyond simply sidestepping potential losses. It's a well-thought-out approach that keeps Berkshire primed for future opportunities. Buffett's choice to hold substantial cash reserves proved incredibly valuable during the 2008 financial crisis, a time when markets were in turmoil and prices on major companies hit rock bottom. With cash on hand, he was able to step in and invest billions in firms like Goldman Sachs and General Electric, companies that, while struggling in the short term, still held solid long-term value. These investments allowed him to negotiate favourable terms, often securing high returns and preferential deals, which ultimately brought in significant profits as markets recovered. This approach showed the real advantage of having liquidity on standby when times are tough. Buffett's method isn't about predicting exactly when a downturn will strike, rather it's about ensuring that he's equipped to act swiftly whenever those rare golden opportunities emerge. By prioritizing readiness over trying to time the market, he exemplifies a core principle. Success often lies not in outguessing market cycles, but in being prepared to seize the right moment when it arrives. It's also worth noting that Berkshire Hathaway's large cash reserve isn't just a safeguard for investment. A big chunk of it supports the company's insurance operations, which include GEICO and various reinsurance businesses. In the insurance industry, a hefty cash reserve is a standard requirement to ensure that companies can cover claims during catastrophic events. At least $30 billion of Berkshire's cash, for instance, is reserved as a safety buffer for its insurance sector. Do you think this cautious approach is the best way to invest, or should he be taking more risks? Share your thoughts in the comments and don't forget to like, share and subscribe for more insights like this.